The Bank of Canada held rates last week. Big surprise. Every economist across the country revised their statements to say they were going to do it a few days before they did. But here's what most people missed. The markets don't believe that the cuts are coming, and inflation isn't dead.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadden, and I'm your host. I can't wait to get you into the flow.
Half of Canada is walking into a mortgage renewal storm with their eyes closed. But is that really the case? Because I thought the storm was canceled, and even I talked about that recently. But today's episode isn't about fear. It's providing clarity. I'm not here to freak people out or scare them. I'm going to provide complete clarity on what just happened and how it impacts you and your mortgage and what's happening across the country. Because believe it or not, there are some surprises creeping up everywhere, and you're going to need to want to hear about this. Whether you're in the real estate market or you're in the real estate industry, this one is a big one. We're going to break down exactly what the B.o.C said and what it really means and how that is going to impact mortgage choices, plus the hidden risks that nobody is talking about right now with debt, delinquencies, and the lender behavior. Let's get right into it right off the bat. I'm not going to make you wait. The B.o.C held rates last week at 2.75%, which was hardly surprising for anybody paying attention to the news a few days before the announcement. Now, prime stays at 4.95% for most banks and lenders, and the market's pricing in just a 45% rate cut in July. Now, that's because we are in a data war, and the data is messy. B.o.C is watching four key things. Unsurprisingly, they're paying attention to how the U.S. tariffs affect exports. Is Trump going to continue to get naughty and beat us up with these tweets? Is he mad at Elon, or is he going to focus his energy back on us? Who knows? But at this point right now, the question is how the U.S. tariffs impact our exports. The second is business investment and household spending is going to be a major factor. Are we spending money, and are businesses investing in new employees, in technology, in things like that, as it has a direct impact to our productivity as an economy? Third is the cost pass-through when it comes to consumer prices. And this means basically because of the potential of inflation, higher tariffs, and it passes it through to the price point, how does that impact Canadians? And the fourth is, and honestly, most critically, is inflation expectations. Do we expect inflation to continue to rise? Because if that continues to happen, things could look even messier. Now, spoiler alert, none of these things are going to provide any urgency for rate cuts, contrary to what the market might believe. And the market actually doesn't believe that's going to happen either way, but that's important for you to know. Right now, inflation is still sticky. Core measures are actually moved up. And the language from the economists and the B.o.C, actually this is for the B.o.C specifically, is that underlying inflation could be a little firmer than we thought. And that's kind of a soft panic sentence if I ever heard one at this point right now. So first of all, here's how the markets are reacting. The 5-year bond yields are breaking through their technical ceilings, which is not good. That means they've broken the trend line, and no longer are we on this beautiful downward trajectory with fixed interest rates. We're actually starting to see some bounce back, which could have an impact on the fixed rate market. We're up over 0.9 basis points in just the last couple of days alone. It's relatively significant. Now, above the 50-day and 200-day moving averages, which likely could head to 3.25% on the yield, which is if nothing else derails the trade talks, which basically means fixed rates are going to head up to the mid to high fours in the near term if that happens. Fixed rates going higher, not lower, unless inflation takes a serious nosedive. So here's the $1 million question now for all those people coming up for renewal in 26 and 27. Or 25 and 26, I should say. Am I going fixed or am I going variable? Now, I broke down every part of this in detail just like a week ago in my last podcast, but it keeps getting asked. So you asked and I deliver. Here's the thing. The fixed rate market is offering certainty, but you're going to pay for it up front right now with the higher interest rate in most cases, not all. And if rates fall in 2026, you're probably stuck overpaying. I mean, that doesn't look like where the trends are going right now. As I mentioned, however, economically speaking, there's a lot that can happen that can impact these markets. Now, the variable rates They feel a little risky right now, but they offer flexibility in the marketplace if things were to change. And if you'd like to take that, you have a high cash flow position, then not the worst thing on earth, if nothing else, to create a little bit of flexibility in your lifestyle, especially with the fair penalty structure, if nothing else, basically providing you for the ability to leave, even with the 3 months of interest being the maximum cost, as long as you're choosing a full featured variable and not one of those restrictive low frills type of products that are out there all over the place. But here's where we're at. The B.o.C has said their neutral rate is 2.25%. And I've seen revised predictions. Scotiabank thinks that we might have another quarter point. BMO still thinks 2.25%, even 2% is likely. But that's basically 2.25 is realistically the lowest floor that you can reasonably expect in this type of marketplace, which means we're pretty darn close to actually bottoming out on the variable rate market. And if you're betting on significant rate cuts, well, that's not a strategy. That's, as someone famous on the internet in the mortgage space would say, hopium at this point right now. What you really need to do if you're thinking about going variable is to have a structure and a strategy that helps you to pivot, because in this type of market, adaptability wins. And what I'm saying is that although the fixed rate market could go back up, it could go back down. And if you have that position where you feel comfortable riding that wave, then taking that variable rate option might not be the worst thing to ride out that little bit of a storm. But you just have to know it might go either ways. So here's an interesting little tidbit. Now that we move off of what's happening in the B.o.C and the fixed rate market, there were some interesting stats that were brought up by Equifax about some simply interesting data that I think most people want to hear. And if you're interested as to where you stand in the marketplace, check this out. Equifax noted that the average mortgage balance per account was $271,000. The average origination amount, which means a new mortgage for first-time homebuyers, repeat and refinance renewal, was $354,400, actually less than I was expecting. The average balance for clients or people switching to a new lender at renewal, $359,400, and the average equity takeout, which might make people feel better, is just taking equity out of your property, was $134,200. That is one that actually really surprised me, because I thought that number would be a little bit lower. Here's what you need to know, though. 28% of people switched lenders in the first quarter of 2025. That means people are getting more strategic about their refinances and less loyalty than ever with their existing lenders. The old 90% renewal rate that we used to see, which used to be the case, that's dead. It's gone. 46% of people switching move between big banks. I think that's an interesting point, because that tells me actually people are not efficiently shopping and they're not doing it the right way. Additionally speaking, this is a key note that I picked up from this Equifax report. First-time homebuyer activity is up 40% year over year, which is probably because rates went down, the market's low, and there's 30-year amortizations and a ton of other incentives. And that is notable and noticeable, because last year it was dead. There was nothing in the water. So truth is, based on all this data, the market is shifting. People are getting smarter. More people than ever are working with mortgage brokers, which is really cool to see. And the reality is, I think people are expecting more than they used to, as you should if you're a consumer in this type of a market. Now, some other interesting key points that came out in the news recently were around debt. Honestly, this stuff really was fascinating to me to read, and you might not have found this surprising. Now, we talked about what Equifax just shared with us, but here's the thing. In TransUnion, they mentioned that Canada's total consumer debt hit $2.5 trillion in Q1. That's $2.5 trillion in Q1. But here's some stuff that really stood out to me. Gen Z was up 30.6% year over year in outstanding credit balances. That's wild in 1 year. Newcomers to the country, $2.6 billion in new credit. Those are not small numbers, and they have massive mortgage implications, specifically around people trying to qualify for a loan in the future. As you know, high utilization of debt, low savings, and multiple liabilities. This is the new baseline for a lot of borrowers walking into the pre-approval process, and I'm seeing it all the time right now. There's more people than ever strapped with cash and outstanding debt and not saving. I mean, from the ground level, Gen Z clients are already stretched before they even start the process, before they get into a conversation. And newcomers to the country, they're carrying payday loans, and they have no idea about how this all works. So there's no education to explain to people like what the impact is. I mean, at what point are we going to wake up and give kids going through university or school some type of education around finance and what it means. I talk to people all the time that are just genuinely unaware. They have no idea how this impacts them, and that blows my freaking mind. Other interesting stuff. Line of credits are up 2.8%. Credit card balances are up 3.2%. And I don't think it's all people going to Bonnaroo or any other festival down in the US where we're seeing everything on prepay loans. We're just seeing so many massive things come in as it relates to credit card delinquencies. Geographically speaking, Alberta's 2.35% delinquency is the highest in the country. Ontario, we saw the sharpest increase in delinquency. They were up 17 beeps to 1.98%, 17, so that's 0.17%. And this all matters because these are the same people that are going to come up for renewal. They're going to need to refinance or requalify. And rising unsecured debt is starting to slowly, silently destroy their ability. So with all that said, she'd run and be scared and think that the market's going to collapse and that nobody's going to be able to pay things off. Not necessarily, but we are going through a little bit of an economic crisis right now in regards to debt. And it's a real thing that's got to be paid attention to. I mean, my overall feedback, as I mentioned, is that I think that it's crazy that we don't have any kind of education in the school system for people who are going through this, or education when they come to our country to say, like, don't just rack up a bunch of debt, do this thing instead. Anyways, I'd love to hear some feedback from you. What do you think the B.o.C is going to do going forward? What do you think the market's going to do? Do you think fixed rates continue to go up because the bond yield looks to be going that way right now? Are you picking a fixed rate right now? And how are you feeling about your debt? Because I'm getting more calls than ever, and I'm helping more and more families navigate these debt situations, which I'm obviously grateful to do. But at the end of the day, if you're trying to make a mortgage decision right now, I would say the worst thing that most people should be doing as it relates to anything real estate related is to bury their head in the sand and hide from it. If you found this helpful, make sure to give me a thumbs up, send me a message. And if you're not already doing so, give me a rating on the podcast. Thanks for listening. We'll see you all in the next one.